Welcome back, everyone. I hope you're having a great day. And in this episode, we're going to discuss the 5 companies to keep on your watch list for this upcoming trading week. These are the companies who are sharing their latest earnings and may be volatile over the next few days, leading to some excellent buying opportunities. And if you're new to the channel, this is a recurring series. Every single Sunday, we take a look at all the upcoming major events, whether it be product launches, investor presentations, or earnings reports, and summarize them into this Sunday episode so you're prepared on what's going on over the next few days and which stocks you should keep your eye on. And for each of the 5 companies in this episode, we take a look at their current operations, some news headlines surrounding the companies, a little bit about their financials, and their future expected growth. So before we take a look at that first stock in today's episode, I'm going to ask you to please hit that like button and subscribe. I am the Gen Z Investor, and every single day we talk about the stock market, going over different stocks you can buy, and any major market news. So please hit that like button, subscribe for the daily videos, and the first company we're going to go over in this episode, worth keeping your eye on over the next few days, is Disney, ticker DIS, currently trading for $185 per share, and over the trailing 12 months, they are up by 75%. They have a market cap at $335 billion, and this company just got some great news over the last month as their theme parks within the state of Florida have officially reopened. So Disney was shut down due to the pandemic, their cruise lines, their retail locations, and their theme parks, and that really hurt the business. But over this tough time, they completely transitioned and have focused on creating media for their fast-growing direct-to-consumer streaming platform, Disney+. And that service crossed 100 million paying subscribers in only 16 months after their launch and has completely turned the company around. So right now, I think Disney, even though it's been on a massive run-up, still has a lot of room to grow going forward. And if we take a look at their earnings, which are projected to come out on May 13th, after market close, they have a revenue estimate of just below $16 billion with EPS of 27 cents. And over the past 4 quarters, they have missed once, but have come in with 3 consecutive beats. And I think Disney is a brand that's going to be around for decades to come. I think their intellectual property is so strong. I think they can always come out with new content to keep consumers entertained. And the Disney ecosystem is so large, so globally diversified, I don't see it going away anytime soon. And to add on top of their already market-leading brand in the entertainment space is the rapid success of their streaming service, Disney+, which I think as alone can be worth hundreds of billions of dollars. So the fact that Disney currently sits with a $330 billion market cap over the longer term as the platform continues to grow and is projected to hit over 230 million subscribers by year-end 2024, I think that service can be worth 100 or 200 billion just itself, and then add in all of Disney's theme parks, which once they get reopened all around the world, are going to go back to being a cash flow machine, generating billions and billions of dollars of income for this company every single year. And if we take a look at their actual income statement, although a huge portion of their business was shut down, like we've already discussed, the theme parks, the cruise lines, all their retail locations, the company still held up extremely well. And in the trailing 12 months, they've generated over $60 billion of total revenue, only declining around $10 billion from their 2019 high. And the fact that this company still generated 60 plus billion when a large portion of their revenue generating activities were shut down just shows how impressive this company really is. And going forward, Wall Street has some major expectations for their expansion in their earnings and their share price, projecting over 47% per year growth. And right now, the stock is considered a buy even after its run up. And the current share price of $184 is below the 12-month expectation, right around $209 per share, implying another 10+% upside over the shorter term. So I think Disney is still one of the strongest companies in the world, and even throughout a pandemic, when many investors thought this was the end for their business and the end for their theme parks, I think it only made them even stronger. They repositioned to focus on the media and the direct-to-consumer, and that has led to immense expansion in their streaming service. The theme parks have now just begun to reopen, and internationally, once they start to open as well, I think Disney over the next 2 to 3 years, we'll see a massive expansion in their total top line, and I would not be shocked if we see them grow to generate over $100 billion in annual revenue by year-end 2025 or 2026. And although Disney is trading near all-time highs, I look at stocks with a long-term perspective, and I think going forward, over the next 5 to 10 years, Disney is going to be a bigger company than where they are today, and they're going to be worth a lot more than the current $330 billion valuation. So I do like the company. I can't wait to see their latest earnings, and on a good or bad report, if the price drops, there may be some great opportunities this week to buy some shares of Disney. So they were the first company we're going to discuss in this episode, and now if we move on into company number 2, it is ticker BABA, which is Alibaba, the Chinese e-commerce company that has exploded over the past few years, currently trades for $225. And over the trailing 12 months, they are up by only 14%, and they have a market cap at $610 billion. And right now, for a company that's expanding at a fast rate, they're trading with a very low forward PE of only 22. And for a company that's expanding faster than the overall market, they're trading with a forward PE ratio below the market average at this current level. And although when you buy into a Chinese brand, there is more apparent risk, but over the past 12 months, Alibaba has gotten through what's expected to be the worst of the scrutiny from the Chinese government. And they did get around a $3 billion fine, but that's nothing, and we'll take a look at the company's financials on why it's such a small amount for the size of this business. And why they're included in this week's episode is because they do share their latest earnings, but because the company has now fallen over 28% back down to their current level from the 52-week high. So I think Alibaba has fallen too hard and too fast, and to currently trade with the forward PE below the overall market average, and to have exponential growth in their total sales in the fast-moving e-commerce and cloud market, it might be a very attractive company to take a look at this week. And for their earnings projections, we're expecting around $28 billion in total revenue, with earnings per share of $1.83. And over the past 4 quarters, they have beaten expectations every single time, and we're forecasting another 41% growth year over year in their EPS. And if we take a look at this company's financials, you'll understand how strong they really are. Back in 2016, they generated $15.6 billion in total revenue. And in a 5-year span, over the past 5 years, they've grown this number from over $15 billion all the way up to $98 billion in annual revenue. From 15 to 98, they've more than 5x'd their total top line in a 5-year span, which is absolutely impressive. And they're extremely profitable as well. So right now, they've generated over $24 billion of total net income in the past year, which is absolutely amazing. And if we take a look at their balance sheet, over $70 billion sitting in cash on the balance sheet. So when the Chinese government gave them a $3 billion fine, investors loved it. That's nothing. They have over $70 billion sitting in cash that a $3 billion fine really barely impacted the overall business. And right now, $91 billion of total current assets with total current liabilities of only $54 billion. So right now, current ratio above 1 and very sustainable. And the total liabilities on the balance sheet come in at $86 billion. So the company's short-term assets of $91 billion can cover all of the debt they have on their entire balance sheet. And right now, $70 billion of cash can almost pay off all their debt. So I'm really not worried about this company having any liquidity issues over the short or medium term. And what's very nice to see is as a shareholder in this company, your total equity has been expanding at a fast rate to over $164 billion as of their latest report. And if we take a look at going forward, the company is considered a strong buy at this current level, coming in at a 1.7, and the current share price of $225 is well below the 12-month expectation of $316. And we can see many firms have maintained their buy rating on this company over the recent months. So I think going forward, Alibaba, although there is some apparent risk with the Chinese government, I think they got through the worst of it right now. They're not going to get delisted from the American exchanges. And for this current price target, I think it may be worth the risk. Definitely take a look at their earnings this week, see what they report, take a look at the numbers, and do your own research into this company. But trading with a forward PE below the market average, they 5x their total revenue over the past 5 years. Highly profitable, great balance sheet with a ton of future upside implied in the price targets. Definitely a nice company to keep your eye on over the next few days. So Alibaba was stock number 2, and if we now jump into stock number 3, it is ticker EA, which is Electronic Arts. They currently trade for $142 per share, and over the trailing 12 months, they're up by 21%. The company has a market cap right around $41 billion, trading with a forward PE of 25.5 and a dividend yield that's extremely small of 0.24%. And this company operates in the video game sector, which we all know has exploded as of late. Then they're the maker of all the popular sports games, including Madden, FIFA, NHL, UFC, and many more. And they also have expansion into some shooter games and some strategy games in their portfolio as well. So right now, EA Sports is well recognized in the video game niche, and that sector has no signs of slowing down anytime soon. And EA also reports earnings this week as well, and we have a revenue estimate right around $1.4 billion with EPS of $1.05. And over the past 4 quarters, they have beaten expectations every single time, and for this next report, we're actually projecting a 2% decline in EPS. So really looking forward to what they put out, and I think the company will give some strong numbers. And if we take a look at their financials, because they're somewhat of a software-based communication company, they have some great financial statements. Total revenue over the long term is trending in the right direction with a record high of over $5.6 billion in the trailing 12 months, and the company remains profitable every single year. But if we take a look at the balance sheet, their short-term assets come in at over $7.7 billion. They continue to expand those every single year, and their current liabilities only come in at 3.5. So a current ratio above 2 and very strong over the shorter term. And their total liabilities are only at $4.4 billion. So very tiny, not a lot of long-term debt on the company, and what we can see is they've actually reduced their long-term liabilities by a significant amount over 2020. So during the pandemic, they made the most of this opportunity to pay down some debt, fortify their financial position, and I think they're very healthy at this current level, and with over $7.7 billion in total current assets, they can deal with all the company's debt, very manageable, and still have a lot of cash left over. And going forward, analysts are forecasting a lot of growth between 14 and 15% per year going forward, and at this current level, the company is considered a buy at a 2.1, and the current share price of $142 is below the 12-month expectation of $159 per share. So Electronic Arts has been a staple of the video game sector for many years, and over the past 5, they have given their shareholders some great returns of over 122%. I think this company will remain a hot player in a growing industry, and definitely worth taking a look at over this next trading week. And now if we transition into stock number 4, we have ticker U. Unity Software, currently trading for $89 per share with a market cap of $25 billion. This is a young company, freshly IPO'd on the market. They've only been trading for less than a year, and this is a software company operating in the video creation and animation sector. And this has been a very volatile stock. We can see it ran up to a high of over $172 per share back in December of 2020. But throughout 2021, we've seen a major decline, and they have now fallen back down 48%. So the company reports their latest earnings this week as well. They are not profitable just yet, but their revenue is expanding at a massive rate. And this is one of the go-to platforms for almost every type of video creator. If you're looking to develop 2D, 3D, or VR games, Unity is the go-to platform. They also create more than just video games. Different automotive, transportation, and manufacturing services, film and cinematics, and all the construction and engineering tools as well. And right now, you can use this for 20 plus different platforms in over 190 countries, and over 1.5 million creators use their software every single month. So this is not a small company. Although they're not profitable, revenue is approaching $1 billion annually. They have a massive network of products on the market, and over 70% of the top 1,000 games downloaded in the App Store are coming from Unity system. So this is a leading tech brand in that sector. Although they are new, they're not yet profitable, and they still have a lot of room to grow and expand. They have seen a massive pullback during the transition away from the high growth companies and into the more value plays that we've seen over the start of this year. So I think now approaching this level, the company's getting a lot more attractive. And big players like ARK Invest have been loading up on shares right around the $85 to $90 range. And if you take a look over this upcoming earnings, they're forecast to bring in $217 million of total revenue and to lose 12 cents per share. And we're getting the numbers after market close on May 11th. And we can see over their first 2 quarters being publicly traded, because like I mentioned, it's been out for less than a year, they actually did beat expectations each and every time, and hopefully they can do it once again. And if we take a look at Wall Street's future projections for this company, they're forecasting 26% annual expansion in the share price each and every year for 5 years going forward. And at this current level, the company is considered a slight buy, coming in with a 2.4. And what I find very interesting is that the current share price right around $90 is well below the 12-month expectation of $140 per share. So the price target set by these analysts implies more than 30% upside to get to this level. And Goldman Sachs has just initiated a buy rating on this company. So I think if the big players like Goldman and ARK like this company as a buy, we're seeing a ton of implied upside, maybe a nice opportunity this week to buy the dip. Especially if the company reports weak earnings, but you do some research and you believe in them long term, you may be able to get the share price off a 50% discount from their all-time high. So Unity Software, ticker U, definitely a new young player in the space, and hopefully once they become profitable and can expand their operations, this could be a major player in the digital, virtual reality, and 3D app and different video creation sector going forward. And now we're going to move on into the 5th and final company included in this week's episode, and it is ticker DUK, which is Duke Energy. They currently trade for right around $100 per share, and this is a boring, stable utility company that provides you with a nice high dividend yield and consistent cash flow every single quarter. On the 12-month chart, they have gone up by 25%. They're trading with a forward PE of 19.5 and a nice high dividend of over 3.8%. And right now, Duke has a current market cap of over $77 billion. And like all the other companies included in this week's episode, they do report their latest earnings upcoming week. And we can see on May 10th, before the market open, we have a revenue estimate of $6.21 billion and earnings per share projected to come in at $1.21. Some mixed results over the past 3 months, and over the past 4 quarters, we have seen 1 miss, 2 beats, and then they were in line with analyst expectations on their past report. And for this upcoming quarter, we're projecting a 6% year-over-year expansion in their total EPS. And if we take a look at their dividend, because this is a utility company, they tend to provide nice high income that grows at a slower rate but is very consistent over the long term. And we can see close to 4% starting yield with a payout ratio of 75% of their net income, which is sustainable and safe for the utility sector. And they grow that payment, averaging 3.27% annually over the past 5 years. And they've been doing it for more than a decade. And going forward, although this is a slower growth company, this is one of the consistent brands you own for the lower volatility. Just kind of buy it, set it, and forget it, and watch it just grow slowly over the long term in a nice, well-rounded, diversified dividend portfolio. And if we take a look at the Yahoo Finance projections going forward, they're expecting the share price to grow by 5% annually. Add in that 4% growing dividend, you're still looking between a 9 to 10% annual expansion in total return coming from Duke Energy. And we can see they are considered a slight buy or even a hold at a 2.6, and the company is still trading just below their 12-month expectation of $103 per share. So Duke Energy was the fifth and final company we're going to take a look at in this episode. This is a utility player I do own in my personal portfolio as well, so I'm really looking forward to taking a look at their numbers, and if the share price begins to fall, I will add to my current position. So now we're going to kind of wrap up the video. I want to thank you for watching to the end. This is a series we do every single Sunday. No surprises, just every week is filled with different companies to keep on your watch list for the upcoming week. And the whole point of the series is to keep you informed on what's happening over the next few days. Over this next week up ahead, no major presentations, nothing too fancy going on, but a lot of earnings reports from some key companies before we kind of wrap up the Q1 2021 earnings season. So I hope you take a look at these companies, do some research. Remember, I'm not a financial advisor, and I will see you in tomorrow's episode.